Hi guys, this is Sector. Welcome to another video of my trading course. In this video I'm going to show you another approach to basically my regular swing trading type of trading. Alright? Of course, all the core principles of my system still apply. It's still trading in the direction of the trend. It's still trading in the direction of the moving averages. It's still trading according to my three simple moving average trend filter condition. Remember, all the moving averages in order, all of them pointing in the same direction, somewhat parallel to each other, etc., etc. Okay, so the basic principles of the trading remain actually the same. The only thing that changes is the actual entry. All right, the way as of how I pull the trigger. Okay. This second way of entering swing trades is basically based on limit orders, okay, as opposed to the method that you've just seen on the chapter number 3 on the course. It's not about searching for reversal formations of the dynamic area of support and of a different elements forming a confluence of support. Okay, it's basically relying on limit orders upon one specific level. So when price reaches that level, our limit orders get triggered immediately, and therefore we are effectively positioned in the market. Okay, as usual, of course, in the direction of the main trend. I'm going to show you now with one example. Okay, in this case is the USD JPY on the daily chart, the Japanese yen, okay, against the American dollar, or rather the American dollar against the Japanese yen, to be accurate. And I'm going to show you exactly what type of conditions you require in order to apply those limit orders into a real live trading scenario. Right? Okay. Let's get down to business. Limit orders, as you know, is an order in which you tell your broker, fill me in at this precise price, okay, not at market price, but at a specific price that I'm going to predefine myself. All right. If you are in an uptrend, okay, as in this case, and price is trading at this level, you've got two ways of entering long other than a market. Well, there are many ways of placing your limit orders, but this precise what I'm actually going to teach you in this video is what we call the limit buy order. Okay, so let's assume we are in an uptrending scenario such as this one, okay, and price is around here. The moving averages and the support area you want to buy from is down here. Okay, so basically what you do is to tell your broker, okay, place a buy limit order right above this area, right above there. Let me zoom in a little bit for a clearer view. There we are. Okay, so let's assume that the 119 level, for example, okay, it's a level where many different elements of support come together within a few pips of each other, and therefore we have a confluence of support at this area. Okay, so basically the idea is to place a buy limit order right here, and a stop loss immediately below this level, perhaps 10-15 pips below that level, no more. It depends on what time frame you're trading off. Of course, if you're trading off the 30 minutes chart, you can't you can definitely tight that stop loss much tighter than if you are trading, as in this case, off the daily chart. Okay, if as usual, the longer the time frame you're trading, the bigger the breathing room you need to give a trade. Okay, but nonetheless, this technique doesn't require long stop losses. Okay, actually, it's the idea is to not to place long stop losses. Okay, all right. Let's go back into this chart. Okay. We are going to focus on this last swing of the chart. All right. As you know, at this precise level, at the 122 area, we have a number of elements of support coming together. Okay, let me zoom out again. We have first of all, as usual, we have the dynamic area of support. All right, between the 30 and the 50. Second, we have this trend line. That's awfully drawn, sorry. We have this trend line right here. Okay, if we prolong this trend line, it comes around this level. Good. We have this swing top. Okay, right there. Former resistance, once broken, might become support. Okay, good. We have the 61% Fibonacci level. All right. That's another element of support in our favor. And finally, we have the 122.00 round number. All of those elements, like I said, come together in the area of dynamic support. Okay, so that 122.00 level is indeed a very strong element of support. Okay, a very strong element of support. There's going to be loads of buyers waiting at that precise level for to enter the market in the long direction. Okay, plenty of them. As I say, imagine Fibonacci traders are liking this level because there is a one Fibonacci level there. To be exact, the 61% Fibonacci level. All right, support and resistance level. Supports and resistance level traders also like that level because it's a former level of resistance. As I said, once broken, it might become support. Okay, trend line traders also like that level because we have one trend line around that level. Okay, and also round number level traders also like that level because, well, we have the 122.00 round number right there. Okay, so as you can see, we have plenty of elements coming together within very few pips, about 10 to 15 pips of each other. Okay, so what's the idea? The idea, let me zoom in even more, right there. Imagine price was somewhere in here. Okay, this swing has topped out and now we are beginning to retrace back down. Okay, the idea is to identify where is the level of the strongest support. Okay, in order to enter this market, we have already said that it's the 122 level right there. Many elements of support coming together within few pips. Okay, so we would place a buy limit. Okay, few pips above this level, perhaps 122.15, 122.10. Okay, right there. And our stop loss would be just very few pips below this 122.00, perhaps 121.90, 121.95, more or less 121.90 would be a good place to place your stops. All right. So the limit entry would be at 122.10. The exit would be the stop loss would be at 121.90. So we are talking about a 20 pips stop loss plus a spread. Let's say a 22 pips stop loss. All right. That's very small considering we are trading off the daily charts. Okay. It's pretty tight. Actually, if you would be trading off the 30 minutes chart, that stop loss can be reduced as much as even 10 pips. Okay, like I say, this strategy requires very tight stop losses. Okay, because it's all about statistics. It's all about probabilities and a risk-reward ratio. Okay, I want to get into that. Let me please finish my point of the entry, and I will explain you what this strategy is based on. All right. So basically, the idea, like I say, is spot out the strongest level of support. Okay, the strongest level of confluence of support, as usual, within the dynamic area of resistance. Of support. And to place a buy limit order just few pips above that. Okay. As price retraces down and reaches this area, our broker would automatically fill us in at that level. Okay, automatically place our stop loss right here. Okay. So here's the idea. The idea is that this level is indeed going to hold the retracement. Okay. Of course, we don't know whether it's going to hold a retracement, but we do know that there are plenty of elements of support at that level. There are plenty of buyers at that level. Okay, price usually, when it reaches this an area of strong support, okay, many orders are punched in the market, and price always sees a retracement, okay, or a bounce off that level. As you can see, immediately after touching this level, okay, we've seen like a 50 pip bounce up to the upside. Okay, please always bear in mind that this is a daily chart, and 50 pips on the daily chart is nothing. Okay, if we were talking about the 30-minute chart, that bounce would have been 10, 12, 15 pips, no more. Okay. So here's the idea. The idea is to get filled in right above that level. All right. Let those many orders that are waiting in the market to be punched in, just like yours. Okay, many limit orders, get a quick bounce to the upside and quickly move stop to break even. Okay, you entered this trade right there. All right. Oops, sorry about that. Right there, you were filled in the market. Price, because all those limit orders that are waiting to be punched in the market, just like yours, we see at least a short-term bounce to the upside. This happens very often, guys, very often. All right, we see a quick bounce to the upside, and what we do is basically move a stop to break even as soon as price has run 10, 20 pips in our favor. Okay, once again, depending on the time frame. All right, but nonetheless, that's the idea. We are getting immediately filled upon touching this level. Many orders are filled in the market. Price sees or goes through a small retracement, a small bounce to the upside, at least for the time being, and we have breathing room enough, perhaps 10, 20 pips, to move a stop to break even. Okay, once we are at break even, well, it's a free trade, no worries. Price might turn around and break this level, the 122 level, or a whole new swing to the upside might be created. I don't know, you don't know, no one knows. All right, no one knows what price is going to do. The idea, like I said, is to get filled in at the most optimum level, very few pips above that level of confluence. Price bounces to the upside due to those limit orders being like yours, which are, trust me, there are thousands of limit orders punched in the market at that precise level. We see a small retrace, we move a stop to break even, and then it's a risk-free trade. Okay, after that, well, you might get lucky, you might see price moving up in your direction, or you might get knocked out of the trade at break even. Nonetheless, it's a win-win situation, okay, or at least a win no loss situation. All right, that's the idea. All right, always in the direction of the trend, guys. It's important. You must have the market inertia on your back. You must have the wind blowing on your back, and blowing you in the direction of the pushing you in the direction of the trend. All right, so once again, it's crucial to spot a strong level of support. Okay, it's usually a good idea if a previous swing top, okay, is a previous swing top and a trend line and a Fibonacci level is lining up at that level. The dynamic area of support, since, well, it's not a specific level but rather a band, okay, a band between the 30 and the 50 simple moving average, you can't really specify one precise level because, like I said, there's a big gap in between the 30 and the 50. You know that you want to enter within that band, but you can't specifically say at what precise level. All right, that's why it's always so important to have many other factors such as a previous swing top, a Fibonacci level, a trend line, etc. You know, levels that you can pinpoint to the pip where exactly you should place your buy limit or a sell limit if you're in a downtrend, and basically just punch or place that limit order 5 pips above that, 10 pips above that, depending on the time frame. All right, and place your stop loss below that. Okay, if price doesn't react off this level and it's just basically breaches through that level in momentum, well, you are knocked out for a 20 pip loss, which is not too bad. Okay, which is not too bad. This entry system is all about risk reward. Okay, you're risking 20 pips, 25 pips to the downside, but the reward is, well, you know, a whole new swing to the upside, which might be 60, 80, 100 pips. Once again, depends on the time frame. But for example, in this precise case, since it's a daily, we might be talking easily about a 200, 150, even 300 pip swing. Okay. So basically, you're risking 20-25 pips in order to gain 200. That's a very good risk-reward ratio. Okay, perhaps this kind of system might fail once, twice, 3 times, but whenever you get a nice entry, okay, whenever you get it right, the risk-reward is like 1 to 5, 1 to 10, or even better. All right. So like I say, it's crucial to have one specific level to base your entry on. Like in this case, it's very clear. You see, the previous swing top comes at 122.10. The 61% Fibonacci comes at 122.5. Right below that, you've got the round number at 122.00. Okay, the trend line right there comes exactly at 122.10 as well. So all in all, and of course the dynamic area of support. So all in all, within 10 pips, you have 4 elements of support. Okay. That means that it's very, very probable that you might see a bounce to the upside, at least a temporary, short-term bounce to the upside, just enough to move your stop to break even very quickly. Okay, you've got to be very nimble with this kind of trading. Okay, you get filled in, price moves up 15 pips, bang, stop loss to break even. It's a free trade. Okay, no sweat. That's what this system, what this entry approach is about. Okay. First of all, a very positive risk versus a reward ratio, and a stop loss to break even very quickly upon the first initial bounce, reacting off that level of confluence of support. Okay. And like I say, even if it goes wrong, even if price basically breaks through, you get filled in the market and price keeps dropping like a rock, okay, you've lost what, 20-25 pips. All right. I think if you can master this technique, okay, it can become very profitable. All right. Like I said, you might get stopped out once, twice, but whenever you get it right, you are getting an enormous reward out of a very small very small risk. Okay, and like I say, please guys remember that most of the trades, if you are to be kicked out, you will be kicked out at break even. Okay, you enter right there, price immediately shoots up, move a stop to break even, and then, well, you know, price might drop down. I don't know. What I do know is that at least, you know, I'm taking no risk on this trade once I've moved my stop to break even, and it usually happens. Okay, it's very common to see a quick reaction, at least a short-term reaction. That's why I said you've got to be very nimble. Okay, you've got to be right in front of the chart in order to move a stop to break even. Once you're at plus 15, something like that, plus 20, depending on the time frame, guys. Always remember that you've got to remember what time frame you're trading, you are basing your trades off. Okay, if you are scalping the market, if you're trading off the 15-minute chart, something like that, move your stop your stop to break even once at plus 7 pips in profit, plus 8 pips in profit. Okay, don't wait anymore. But if you're trading off the daily, well, perhaps you may want to give it a little bit more of breathing room, plus 15, plus 20, no more. Okay, upon that initial bounce, which like I say, it happens very often. Okay, those limit orders waiting to get filled in, they all get filled in at the same level. Okay, they all get filled in at the same time, and price reacts of that. You usually see, like I say, a quick bounce. You see this green bar that right there, or even this red bar. Okay, price reach down, touch this strong level of support, and you see where it closed, this bar. Okay, this was the touch. This would be where we would have gotten filled in, and look where this trade, this bar closed. Okay, you have like 20 pips there to move a stop to break even. Perhaps in this case you might have gotten stopped out in this next bar right there, stopped out at break even, but nonetheless it's a break even trade. Okay, it's worth to give it a try. Okay, because most of the times either you get stopped out at break even, or you may see a whole new swing to the upside for very small, for a very tight risk. Okay, barely 20-25 pips, and you could have easily moved stop to break even here. Okay, it's a very common phenomenon. I see it every day that touch limit orders get filled in the market, bang, rebound back up 20-30 pips, move a stop to break even. Hey, that's it, no sweats. I'm riding a risk-free trade. I don't care anymore what might happen from now on. Okay, like I say, that quick temporary rebound to the upside or to the downside if you are in a downtrend, basically off that level of confluence, happens very often. All right, alright guys, that's what this technique is about. Okay. Now I've got to be honest with you. This is not a conservative type of trading. Okay, this is just not a conservative type of trading, because you're not waiting for the confirmation. You're not waiting for the reversal confirmation. All right, you are not waiting for the retracement trend line breakout. You're not waiting for that. You are entering right here. You're not entering right here upon the breakout of this trend line. Okay, you're basically anticipating the market, or trying to anticipate the market. That's always risky. All right, guys, I don't want to lie to you. This is, first of all, it's not so easy to master. Okay, it doesn't happen very often, because like I said, you've got to have a very strong level of confluence. You've got to have many elements of support coming together at one specific point in the chart. But once you've gotten the grip of it, once you're accustomed to this technique, you can easily move a stop to break even if you're nimble enough. Okay. But like I said, please always keep in mind that this type of technique well, basically carries a higher degree of risk. Okay, you're not waiting for a reversal formation. You're not waiting for price action confirmation. You're not waiting for a retracement trendline breakout. Like I say, you are basically anticipating the market. Okay, you are entering a position before the market has showed you the next move. Okay, that's always risky. I don't want to lie to you. All right, so my advice before entering any live trade based on this technique, please demo. Alright, always demo a number of trades, 10, 15, 20 trades, and once you believe once you've achieved good results, once you are comfortable with this technique, then go live with very small lot size. Okay, very small lot size. Nonetheless, like I say, you're trading a higher degree of risk technique, okay? And well, you know, you don't want to go a commando, you don't want to go berserker from the very beginning, using a new strategy that, first of all, you're not accustomed to. Second, it holds a higher degree of risk, okay? Nonetheless, it's a strategy that works. Okay, I personally don't use it very often because I'm a conservative trader, and second because I do enter the trade with a higher than usual lot size. Nonetheless, it's all about how much risk you're willing to take, and also how comfortable you feel with entering the market without waiting for the confirmation. The limit order technique does work, but only once you've mastered it. It's a little bit like the London Open breakout type of trade. Okay, you will learn all about it in this course, or at least the way I trade it. The first thing I say on that chapter is that, guys, please be careful. This is a high momentum technique, and it's more difficult to trade than let's say a triangle breakout. It's just more difficult. Okay, so make sure you've traded plenty, you've taken plenty of demo trades before going live. Okay, well, this is the same. Okay, this technique does work, but be careful at least at the beginning. All right. Okay, guys, that's basically all. Now I recommend you to, go through many charts, try to spot different areas of confluence of support or resistance, depending whether you're in an uptrend or downtrend, and check by yourself, verify by yourself that if you do have a strong level of support or resistance, you will see that price, upon touching that level, you always see a quick bounce to the opposite side, okay, in the other direction, just enough to move stop to break even. Okay. Yeah, trust me, it does happen, okay, and in order, but you gotta believe it yourself, okay. Don't trust what I say. Go back in the charts, okay, spot those areas of confluence, okay, with previous swing tops, trend lines, Fibonacci's, round numbers, etc., and you will see that you always get, if they all come together within a very tight area, you always see at least temporary a bounce to the upside, just enough to move a stop to break even. All right. Okay, guys, that's all for this video. Any question? Okay. Any doubt you may have, please feel very free. You're very welcome to send me your charts, your emails. Okay, I'll gladly give you my feedback. All right. Okay, guys. Cheers. I'll see you in the next video. Bye bye.